Financial Intelligence Deep Dive, your daily source for clear, focused market insights. It's Thursday, August 21st, 2025, which means portfolios are probably carbo loading for Friday. Let's warm up with some real data, not just pre-market chatter. Today, we're diving into the intelligence brief for yesterday. That's Wednesday, August 20th, 2025. We'll be pulling out the most important insights from the sources you've given us. We're talking market moves, sector stuff, currencies, key data, the works. Now, yesterday saw a really sharp rotation out of those high-flying U.S. tech stocks. That triggered a pretty broad risk-off tone globally, meaning, well, investors were basically pulling back from riskier things like stocks and moving towards safer assets. But, as we'll get into, the picture wasn't entirely uniform. There are some pretty fascinating nuances in how it all played out, and this deep dive is powered by NextSight. They're a global intelligence company that really goes beyond just collecting info. With their open-source OSINT platform, Site Connect, they actually turn raw data into strategy. And, importantly, they let clients shape reports around their exact priorities. From financial market analysis to, say, cross-border investigations, their work consistently operates on another level. You can learn more at www.next-site.com. Oh, and a quick heads up. Today, the moderators plan to settle a critical question. Do dividends count as self-care, or is it just responsible adulthood? Something to ponder. Okay, let's unpack this market brief. Let's kick things off where the action was most pronounced. The equity markets, especially in the U.S., we saw the S&P 500 slide about, 0.36%? And the Nasdaq composite really felt the pinch. Yeah, it fell around 0.85%, hitting a two-week low. So what was truly driving this tech sell-off? The sources point to, well, classic overstretched valuations for one, but also some specific catalysts, right? Like a talk of government stakes in AI chip companies through the TAPS Act.
The TAPS Act aimed at boosting domestic production.
Exactly. And also maybe some caution ahead of the Fed's Jackson Hole Symposium, that big annual meeting.
Always a closely watched event.
You also shared details from Reuters, specifically highlighting the U.S. government looking at taking equity stakes in chip makers. That's significant. What's kind of intriguing here is how quickly that narrative around AI profitability shifted. We heard comments from OpenAI Sam Altman sort of hinting that AI profits might be, well, far off. And there's other research questioning near-term revenue, too. Does this sudden shift tell us something, deeper about how fragile this whole AI-driven rally is, or is it just short-term noise?
Well, I think it definitely highlights the market's hypersensitivity. It's sensitive to both valuation worries and policy cues in these high-growth areas. The fact that Nasdaq had its worst two-day drop in months based on these specific stories, even though the daily percentage change wasn't enormous, that speaks volumes about the underlying anxieties, I think. This AI narrative shift, especially the profitability, is far off comments. It does feel a bit reminiscent of some discussions back in the dot-com era. It just underscores that current valuations lean really heavily on belief in future profits, not just what's happening right now.
So fundamentals versus hype again.
Pretty much. Investors really need to be braced for sharp corrections when sentiment flips, even on seemingly small news or policy hints. And that immediate rotation into more defensive names. That's a clear signal. Traders are trimming growth exposure, hinting at broader concerns maybe about economic momentum or potential policy slip-ups.
Right. So while U.S. tech dipped, we saw, well, a remarkably different story in other places. The Dow Jones Industrial Average, for instance, ended roughly flat, not down like the Nasdaq. And then across the pond, the FTSE 100 in the UK actually jumped a full 1%, hit a record close, and that was largely driven by defensive consumer names. Seems like a really strong divergence. What's behind that? And how did Europe and Asia generally fare with this risk-off mood?
Yeah, that divergence is absolutely a critical piece here. The rallying in the FTSE 100 led by solid gains in consumer staples, think Unilever, Reckitt, and healthcare. It points to a very clear rotation towards stability, and this happened even as UK CPI, the inflation number, accelerated to 3.8%.
Which is the fastest since early 2024, right? Usually that dampens rate cut hopes.
Exactly. It reduces hopes for a near-term Bank of England rate cut, but investors still judge that these defensive sectors offered more resilience in an uncertain environment. On the continent, European shares were kind of steady overall. The STOXX 600 gained 0.2%. But Germany's DAX fell 0.6%, dragged down by its exporters and tech names, reflecting that global tech sensitivity again.
Okay.
And then in Asia, markets were generally weaker. Japan's Nikkei 225 down 1.5%, Korea's KOSPI off 0.7%. That was influenced by some profit-taking, a stronger yen, and maybe caution ahead of chipmaker earnings. However, and this is key, mainland Chinese equities actually bucked the trend.
Buck the trend, bow.
They rallied to 10-year highs, mostly on hopes for more stimulus and reform of state-owned enterprises. So you really see this split. a global market feeling a common risk-off impulse, but then diverging sharply based on local policy hopes and sector specifics.
Interesting. Okay, let's shift gears. Moving from equities to interest rates and currencies. This area always has such direct implications for, well, for all of us, right? Mortgages, international trade. The sources highlight U.S. Treasury yields being little change. The 10-year yield hovering near 4.34%. The 2-year near 3.77%. Pretty stable. But digging deeper, the nuances in the Fed minutes released yesterday, those are truly fascinating. What did those minutes actually reveal? And what's the market maybe missing?
Yeah, the July meeting minutes from the Fed are quite revealing, actually. They showed almost all policymakers favored holding rates where they are, at 4.25%, 4.50%. Only two, Governor Bowman and Governor Waller, dissented. One had cut.
Only two.
Just two. And this is really crucial because despite that clear consensus for holding steady, the futures markets, well, they're still pricing in over 80% odds of a September rate cut.
80%. Wow, that's a huge disconnect from what the minutes suggest.
It's a significant disconnect, exactly. The Fed's own words point one way, the market's betting heavily the other way. And that chasm really sets the stage for Fed Chair Jerome Powell's speech at Jackson Hole. It becomes a key risk event. Any hint of hawkishness, a more aggressive stance on rates could shift those market expectations dramatically.
So the market's trying to get ahead of the Fed again?
Classic case, yeah. But with considerable risk this time, given what the minutes said.
Okay. Beyond rates, the currency markets saw some unexpected moves too. The U.S. dollar index, the DXY, which tracks the dollar against other major currencies, it slipped 0.13%. Seems small, but maybe not when you consider one of the catalysts mentioned in your sources. U.S. President Trump publicly calling for Fed Governor Lisa Cook to resign. That's unusual. Directly wading into central bank independence.
Highly unusual, yes.
How did that, and maybe other factors, play out across global currencies?
Well, the dollar definitely softened after that public demand regarding Governor Cook. It's quite significant, as you say. It underscores that political pressure on the central bank, and it caused traders to trim some dollar positions, hedge their bets a bit. Consequently, the euro firmed up to around 1.1657, and the yen strengthened to 147.2 per U.S. dollar. Both supported by these shifts and also the broader risk-off flows we talked about earlier.
Right, the move to perceived safety.
Exactly. But risk currencies were notably weak. The New Zealand dollar, for instance, dropped 1.12%. That was after the RBNZ, the Reserve Bank of New Zealand, cut rates for the first time in 18 months.
So they're moving in the opposite direction policy-wise.
Precisely. A distinct monetary policy divergence. Sterling also fell about 0.3% after that hotter-than-expected UK inflation print we mentioned. That might temper Bank of England rate cut expectations, meaning potentially higher rates for longer there. And in the crypto space, Bitcoin dipped slightly, 0.22%, to around $113,322. Ethereum hovered near $4,090. It just underscores a broader reduced appetite for risk in speculative assets, kind of echoing the tech stock sell-off.
Okay, let's turn to commodities and energy now. Despite ongoing peace talks in Ukraine, which you might think would soften energy prices, oil actually rallied. Brent crude settled up 1.6% at $66.84 a barrel. WTI up 1.4% at $63.21. Feels a bit counterintuitive. What's the story there?
You're right, it does seem counterintuitive on the surface, but the core story here is really about U.S. crude inventories. The EIA, the Energy Information Administration, reported a massive 6 million barrel draw in U.S. crude stocks.
6 million. What was expected?
The consensus expectation was only about 1.8 million barrels. So this was more than triple that. Analysts are attributing this big draw to a strong rebound in exports and also high refinery demand domestically. So even with the Ukraine peace talks adding some geopolitical noise, this strong domestic demand signal fundamentally pushed prices up. But it's worth remembering, despite this bounce, both Brent and WTI are still down double digits year to date. Those broader oversupply concerns haven't completely vanished.
Got it. And what about precious metals? Gold, for instance, often seen as that safe haven asset in uncertain times. Did it play that role yesterday?
It did, yes. Gold rose 0.9% to $3,344 an ounce. It was definitely helped by the softer dollar makes gold cheaper for holders of other currencies, and critically, also helped by those ongoing expectations of a Fed rate cut that we just discussed.
The lower opportunity cost idea.
Exactly. That combination makes gold more attractive, and you even saw Goldman Sachs reiterate a pretty bullish price target, $4,000 an ounce by mid-2026. So there's still strong long-term sentiment there. Silver also saw a healthy rise of 1.1% following gold's lead.
Okay, finally, let's touch on real estate. This impacts so many of us directly, whether you're, buying, selling, or just watching the market. Your sources gave us a bit of a mixed picture for U.S. housing data from the day before. Single-family starts were up, but there's a nuance with permits. What should we take away from that?
Yeah, the U.S. housing data showed some surprising resilience, at least in starts. Single-family housing starts rose 2.8% to a 939,000 annualized pace. Multifamily starts jumped 11.6%. So overall, total starts were up a solid 5.2%. That looks good.
Ah.
But the nuance, and what raises an important question, is that permits for future construction actually fell 2.8%. They hit 1.354 million, which is a 5-year low, mainly because multifamily permits plunged.
A 5-year low in permits, that sounds like a warning sign.
It suggests that while current demand seems steady and homes already started or getting built, future supply coming online could face real constraints. Builders are still dealing with high financing costs, right? Even though the 30-year fixed mortgage rate eased a bit to 6.58%.
Which is its lowest since October 2024, but still high compared to recent history.
Exactly.
Yeah.
Historically high. So that strength in starts might be more of a lagging indicator, while the drop in permits points to potential headwinds for future growth in housing.
Okay, so connecting all these dots, all these different data points, what does this really mean for those of us tracking these complex markets day to day? It feels like yesterday's main theme, tech valuations hitting up against policy uncertainty, really rippled across pretty much all asset classes.
Absolutely. I think if you connect it to the bigger picture, you see this clear tug-of-war playing out. On one side, you've still got some persistent bullish narratives floating around. There's the anticipation, maybe hope, of a Fed policy pivot towards rate cuts. That's still baked into market expectations, as we saw. You've got hopes for Chinese stimulus driving their stocks to 10-year highs, and you have that clear leadership from defensive sectors, providing a bit of a cushion.
Okay, so those are the bullish points.
Right. But they're being fiercely balanced by some significant bearish narratives and, frankly, risks. We've got those very real concerns about AI valuations maybe being in a bubble. There's the potential for policy miscommunication from the Fed at Jackson Hole. It's a big one. Ongoing geopolitical uncertainties like Ukraine, and then sticky inflation popping up in places like the UK CPI data and U.S. housing costs. Those housing headwinds, especially that 5-year low in permits, that also suggests a potential drag on future growth if demand were to weaken. So, yeah, it's a market really defined by these competing forces right now. Needs careful navigation.
So looking ahead then, maybe the next 7 to 10 days, what are the critical events? What are the actionable insights we should really be watching closely? What are the major catalysts coming up that could genuinely shift this market narrative we've been discussing?
Yeah, the immediate future is definitely packed with potential market movers. The Jackson Hole Symposium kicks off tomorrow, August 22nd. Fed Chair Powell's speech there is absolutely paramount. Any hints he gives on the policy outlook could significantly shift rate expectations and bond yields.
Hawkish versus dovish.
Exactly. A hawkish tone could pressure equities, pressure gold. Dovish remarks could support risk assets. Big implications either way. Also, on August 22nd, tomorrow, NVIDIA's earnings release. That's going to be a huge test for those AI-driven valuations we talked about.
Right, a bellwether for the whole AI theme.
For sure.
Yeah.
Strong results might restore some tech sentiment. A miss could trigger further rotation out. Looking a bit further out, we'll be watching U.S. durable goods orders and new home sales on August 26th, and then critically, the U.S. PCE inflation data for July. That lands on August 27th.
PCE, that's the Personal Consumption Expenditures Index, the Fed's preferred inflation gauge, right?
That's the one. A low print there would definitely bolster those rate cut bets. A high reading could easily cause sell-offs across risk assets. So, very important number.
Okay, so bringing it all together then. What does this mean for you, the listener, in terms of actionable insights? Based on these sources, how should you be thinking about navigating the coming week or so?
Well, based on these shifts we've seen, some operational watch items come to mind. Maybe considering trimming some high beta tech exposure at any rallies, perhaps rotating a bit more into defensives, consumer staples, healthcare, like we saw in the UK. Selectively adding some duration with U.S. Treasuries or high-grade bonds could make sense to capture potential rate declines if the Fed does pivot. It probably also pays to hedge currency risk, given the recent volatility we discussed.
Especially with things like the president commenting on Fed governors.
Indeed. Monitor those housing indicators closely, too, particularly permits. And I think most importantly, just prepare for increased volatility around Powell's Jackson Hole speech. Be ready to adjust positions quickly based on the guidance he gives. This really isn't a set-it-and-forget-it market right now. It demands active awareness.
And that concludes the Wednesday, August 20th, 2025 Intelligence Brief delivered to you on this Thursday, August 21st edition of the Financial Intelligence Deep Dive. We really hope this deep dive has given you a clearer, maybe more focused understanding of yesterday's market movements and what to keep an eye on next. Don't forget to subscribe on YouTube and Spotify. Drop us a like, a share, a comment. We genuinely love hearing your perspective. One more sleep till Friday. Let's finish the week smart.